Hello, everybody. I'm Shiraz, the president of FinTeens, and I'm joined today by Ben, our vice president. FinTeens is an international youth organization that unites high school students and college students from over 40 countries who are passionate about finance. We aim to provide our members, regardless of their stage in the financial education, with unique opportunities for learning through episodes with top financial executives.
Today, we are excited to host Mr. Cho. Mr. Cho is a managing director at Range Summit Capital, bringing over 2 decades of extensive experience in real estate investment management. Throughout his career, he has managed $650 million of equity investments, which have been part of over $2 billion in real estate transactions across more than 20 states. Before his current role, Mr. Cho was a managing director at JCR Capital in Denver. Since joining Range Summit Capital in 2017, he's continued to shape the landscape of real estate investment. Thank you so much for joining us today, Mr. Cho. And
Thanks. Happy to be here.
Our first question would be reflecting on your career. Could you share a challenging moment or project that significantly impacted your professional development?
Yeah, sure. I'd say the most challenging part of my career is understanding that there's no really perfect time to you know, start a new job or start a new company. Now there are plenty of times where it's a terrible idea to do that, and you shouldn't. But if you're at a job and you're kind of waiting around and you feel like, perhaps I don't have enough money or I have too much responsibility and I can't start something new, um, recognizing that was difficult, and it may have caused me to stay in, a couple different jobs longer than maybe I should have. Now, again, as I said, you can't be cavalier about it. You can't just, jump around whenever something's not working out or you're not happy. But sort of recognizing that is important, and it's a challenge. And once I sort of figured that out, that's when I started Range Capital, which was about 7 years ago. So in 2017. And it's been a great move for me.
Yeah, definitely. Thank you for that insight. So just moving on to more of your role at your current role at Range Summit Capital, could you tell us a little bit about what your typical day looks like and what type of activities you do and maybe how that sort of looks like?
Sure. So Range Capital is an LP investment firm, and what I mean by LP, that stands for limited partner. So let's say, Shiraz, you and Ben, you wanted to buy an apartment building, and it was $30 million. Well, you'd get a loan for 20 million, and that means you'd need 10 million in equity. Range would bring in 9 million of that, and you and Ben would bring in 1 million, and we'd be partners. We'd be 90-10 partners. But you'd be the day-to-day owner or manager of the apartment building. So you'd, set the rents and call the plumber, pick the paint colors, or have your management company do that. And then in exchange for doing all that work, maybe when we sell the building, you'd end up getting 35 or 40% of the profits, even though you only put 10% of that equity in. And then what Range does is we invest that $9 million in this example out of a discretionary fund. So we raise a fund of, let's say, $90 million. And so we can place 10 $9 million investments with 10 different guys like you, but different, like it's not always Shiraz and Ben, it's other guys in different parts of the country, different real estate assets, different business plans. So that's what Range Summit Capital does. Now, what I do as the director, it's a lot of time on the phone. It's a lot of time on the road. I see a lot of assets. I go meet a lot of sponsors. And, I guess when you move from being a deal guy, which is what I was at my last two jobs, to sort of being in charge, you have to trust the people who work with you. To do that. And so I don't, for instance, I don't really mess around on financial models a lot anymore. But the first, I don't know, 15 years of my career, all I did was financial modeling. but that's not really the best use of my time now. So, I guess learning how to delegate, that's a big part of my job. And then another part of my job that I never did at my previous jobs was raising capital. So as I said, on one side of the company, I'll invest money with, you and Ben to buy that apartment building. But on the other side of my company, we have to bring investors in to the funds or the vehicles that we invest out of. So that's pretty much my day to day.
Yeah, thanks for that. So touching on what you said about your interactions with investors, how would you say you approach investors, and how do you gain their trust and build a relationship with your clients over time?
Yeah, and that's the key. What you said is over time. It definitely starts off with smaller investments. You kind of take baby steps. A lot of our investors are just kind of like wealthy people, family offices, kind of small fund of funds. So uh, getting like word of mouth, like getting recommended or referred to an investor from another investor, and sort of building that sort of organically. It's really important. In fact, it's the most important thing, part of raising capital. So you just have to, again, you got to start small, and even though you're talking to an investor who can write a $10 million check to your fund, you got to start small. And if he's like, well, I'll take a test drive with $500,000, which to him might not be a lot of money. It's a lot of money to most people, but and you just have to build on that. And again, you kind of, at least the way we do it, you have to kind of grow slow. And I'm not suggesting by any means that hiring a bunch of people to raise money for you, and sort of exponentially growing your fund. I'm not suggesting at all that that's a bad way to run an investment management business, but that's not how we do it. And again, relationships are the most important part of that.
Yeah, totally. Um, so another question would be, from your perspective, what are the current trends in the real estate market, and how might they evolve through the next few years?
Yeah, I mean, we're definitely seeing, uh, starting with COVID, which was a massive disruption to real estate. Um, we're definitely seeing sponsors getting more creative about reusing or repositioning properties. Hotels to apartment buildings is a very common one, and that's not too difficult to figure out. What to do with office buildings, or resetting uh, the office market at a lower basis is definitely something that everyone in our industry is thinking about. COVID also changed dramatically the use and the importance of industrial property or industrial assets, in America. So there's a lot of change going on right now. And what we do is, because again, we're not direct owners of real estate. I don't run things on a day-to-day basis. It's just paying attention, right, and communicating with sponsors about what they're seeing, and even going to conferences and just listening to um, what sponsors are out there doing. There's another uh, asset or a business plan, I guess. It's called Build to Rent, which is it's not a great name, but everyone knows in our industry what build to rent means. And what it means is, instead of building apartment buildings that are high rises, like you think of an apartment building, it's 2, 3, 10 stories, and you live in a flat. What a lot of real estate sponsors are understanding about younger people now, and the way they look at rental property, is that they're looking at renting maybe on a much longer term basis. And so what build to rent means is you build what we call horizontal multifamily. So you build a lot of, I guess, casitas or townhomes, or you build homes with little yards, and you sort of rent them. Even though they look like houses, you're not building them to sell to people, that you're building them to be permanent rentals. And so that's another, aspect of whether it's a demographic or a cultural shift, that you just have to pay attention to. I was at a conference, I don't know, maybe 6 weeks ago in Tahoe, and I was just blown away by how many sponsors do build to rent. which is like, again, these horizontal multifamily projects. So, paying attention to that and just kind of listening to what people are telling you is important. I know it sounds silly, but there are a lot of people in my industry who've been very successful doing things a certain way, and they're always going to do it. They've always done it the same way. And that they're maybe not necessarily paying attention. And those types of people tend to be maybe a little bit older, so they're a little bit further on in their career. So maybe they don't have to worry about tracking new trends. But for us, it's very important to pay attention.
Yeah, definitely. So after you identify these trends, how do you go about your investment process and you find the opportunities that you actually want to allocate your funds towards in such a fragmented market such as middle market real estate?
Yeah, and I'll go back to this again. It starts with relationships with sponsors. If you think about that example I gave you, where it's a $30 million project, you need 10 million of equity, and I'm giving you, Shiraz and Ben, $9 million. I mean, you're basically in charge of that money. Now, of course, there's plenty of rules, and we have business plans that you have to adhere to, and there are legal, operating agreements that give you guardrails. But really, you are, working with our money. So um, trusting you, building a relationship with you as the sponsor is so important. So, we really don't do deals with kind of first time sponsors or sponsors who are trying out a new business plan, even though it's something that we might recognize. Like, we need to make sure that, those sponsors just have experience in the business. And the biggest mistakes I've made in my career, like without question, are the ones where I didn't choose the right sponsor, right? It just didn't make the right decision, right? And these sponsors, maybe they talk a big game, and they can even give you good references, but you just have to pay attention and building that relationship, going slow, and maybe not jumping in at the first opportunity that sponsor gives you, but keeping in touch with them and seeing how that opportunity went, and then maybe you do it the second or the third time when they get something else. So yeah, I mean, those relationships, especially in middle market real estate, are extremely important.
Definitely. So after you decided your investments and like how would you go about that diversification process to you know reduce your risk among different investments and especially in the field of real estate? I know that economic cycles can definitely impact real estate. So how do you go about that?
Yeah, I mean, you have to, in our fund, we have and not just our fund, almost, well, hopefully every single fund out there, they have allocation guidelines. So we have different buckets by geography, by asset class, by sponsorship, by business plan, and by equity structure. And by equity structure, I mean, we make preferred equity and we make joint venture equity investments. I won't get too far into the weeds with you on the difference there, but the point is this, our fund cannot be more than 40% allocated to multifamily. Our fund cannot be more than 30% allocated to Southwest markets, Texas, Arizona. Our fund, so we can't just be a California fund. We can't just be a multifamily fund. So having those allocations, those guardrails in place, they're very simple. They're just simple rules, and it's the only rule that you can't break, right? You just can't have too many assets in Phoenix, or you can't have too many industrial assets, or you can't have too many sort of value add type business plans. You have to have, we've had funds where you've got, land in San Diego and a medical office building in San Antonio and an industrial building in Beloit, Wisconsin. I mean, those are, and they're different business plans as well. And so you just, it's just deciding that those allocations are there and then not breaking them. And that again gets me to back to the point of having a lot of relationships, good relationships with sponsors, because I can't tell you how many times I've turned down a deal from a sponsor that I know will do a great job, but I just have too much of what they do in the fund, so I can't put it in the fund. It's just over allocated. And so diversifying that risk, as you mentioned, it is so important.
Totally. Going back to relationships and sponsors, what specific factors would influence you to cut ties with a sponsor?
Certainly bad behavior. The obvious ones would be, misappropriating money, which is a fancy word for, I don't want to say stealing, but just not using the money for the purpose it was intended to be used. Um, Sponsors who don't produce reporting on time. I know it sounds silly because we're in the real estate business, and so everyone thinks, well, if the real estate's good and the investment's good, what's the problem? But sponsors who don't make cash flow distributions on time, sponsors who don't provide balance sheets, income statements, tax returns on time, sponsors who just don't communicate well. Going back to the example where I've given you, Ben and Shiraz, $9 million, like if you're not giving me constant updates on how the business plan is progressing, it's a red flag. And I have cut ties with plenty of sponsors for, well, the exact reasons I just described. And so, yeah, I mean, you definitely, we hold them to a very high standard, and it's important that you continue, you always do that.
Definitely. Yeah. So kind of going back to risks in the real estate market, how would you say, especially as we're in an inflationary economic period right now in the United States, does your firm go about mitigating these risks regarding interest rates and how they affect the real estate market?
Yeah, I mean, you just have to, when you're assessing a real estate investment, you just have to look at the basis, at which you're purchasing, and it kind of all starts there. And I know it sounds simple, but um, as you noted, inflation is up, which means borrowing costs are up, which means, exit cap rates are higher, and that means you can't sell things for, kind of as much as you could 18, 24 months ago. And just adjusting, sort of just resetting where you think you should be purchasing these assets based on where you think you can sell them. It sounds simple, but you can't be super aggressive about where you think those types of rates are going. I mean, we've gotten caught a couple times, and we're in that sort of area right now where it's like, yeah, we underwrote deals a couple years ago. We were a little aggressive on our exit cap rates, but fortunately, some of our deals aren't based on exit cap rates. And, you talk about diversifying risk. Not every single deal is based on, a property makes $100 of income, you put an 8 cap on it, and now it's worth $1,250, right? We don't just invest in those types of business plans, right? The last deal we just sold was a vacant piece of land. It was in Southern California. It was industrial land that our sponsor thought that, or knew that he could rezone and turn it into a great lot or a great site for build to rent housing. And he went through that entitlement, and then, he essentially bought us out. But the point is we paid $100 for a land. We thought based on the housing values and, sort of someone who'd want to build it, it was going to be worth $150 once you finished all those entitlements. And he was right. And so that has nothing to do with income or cap rates, right? That has to do with housing demand and, basically buying it at the right price. So having different types of business plans also mitigates that risk, because not all business plans are based on, rates of inflation, rates of growth, or cap rates.
Yeah, totally. Because COVID had a major effect, I assume, on real estate. How exactly did it affect you in Summit as you had to
Oh,
go through it?
yeah, I mean, in so many ways. I mean, first of all, when COVID, you know, first hit, so it was March of 2020. I mean, people thought the world might end, right? And so our business stopped, just completely stopped for a period of several months. Once everyone realized that the world was not going to end, and then people started realizing, well, interest rates are near zero, so borrowing costs are incredibly low. There was a lot of pent up demand there to make investments because people still had money to invest. And so there was this huge rush of investment capital, which was actually, very beneficial for our business. And then you sort of layer on to think all of the things that I talked about, right? The office market just completely collapsed. Thankfully, we didn't have any office at that time. Eventually the industrial market, all of it's called onshoring, all of that industry, or not all of it, but a huge portion of the industry that was occurring in Asia, South America, it came back to America because, shipping things from, I'm not going to pick on China, but shipping things from China to America, right, the cost, quadrupled. So it became much more feasible to, sort of onshore or bring that production and distribution back to North America. The same thing with, companies like Amazon, right, where, people, because of COVID, were ordering things and they got into the habit of ordering things. And even now, when COVID is not the health crisis that it was before, people are still ordering things like crazy. And so that, requires real estate. The travel industry obviously shut down for like a year. And so all those hotel owners, I mean, especially the smaller ones who, they're not like big hotel companies that own all these hotels. They're just like mom and pop business owners that own, a couple, extended stay hotels. I mean, they got absolutely annihilated by COVID. And so now they're trying to sell their hotel investments. We have sponsors who buy them. They want to convert them to multifamily, to housing. And again, housing, the fact that people weren't building any housing for a year is a huge, I mean, there was already a housing shortage before COVID started, but the fact that people stopped building housing for a year, I mean, think about what that does to the economy. People still need to live. That's the one thing that you can't do virtually, right? You can work virtually, you can shop online, but you can't live virtually. You still need housing. So all of those um, factors, I mean, affected our business. And I mean, Ben, I could go on and on and on about things, how COVID sort of the dislocation worked its way through the real estate industry in both, beneficial ways and horribly detrimental ways. But yeah, I mean, it's been a shock, and here we are, it's 2024, and we're still sorting things out. I mean, in very many ways, we're still sorting things out.
Yeah, I'm sure that sounds chaotic.
Yeah, a lot of chaos.
Yeah, so definitely. We want to ask a few questions about more about your career and get some few insights on that. So, what were some pivotal moments early in your career that really set you up for a career in real estate, and what advice would you give on that end?
Well, I don't know that I could point to any pivotal moments. I, went down a very similar track as a lot of people. I mean, aside from the fact that I had a law degree, I got a degree in real estate and went out and found the best job I could. And it was not a great job, but it was something. And that's really the advice I would give to anyone in the early part of their careers. Now, the advice changes a lot in the later part of your career, but in the early part of your career, just take whatever the best job you can get is, and don't focus necessarily on what the title is or what colleagues or friends of yours, the jobs they're getting in real estate, right? If someone that you think you're smarter, just as smart as, they get some, you know, analyst job or some associate job at some firm, and you're like, well, I want to be an associate. I don't just want to be an analyst or an intern or a runner. I mean, just get a job in real estate, get the experience when you're young, and just work it. Now, I understand there's all sorts of considerations about, your income and being able to live, and you got to work through that. So the best job that you can get might be the one that, it might not be the job you want, but it pays you what you need to live, right? And you got to figure that out, but don't just wait around and, I guess, get wrapped up in titles or get wrapped up in, comparing yourself to what track other people are on. Just get that experience. And that could be, that doesn't necessarily have to be, being a financial analyst at a real estate company, right? You can work for a brokerage firm. You can work for a property management company, even working for a title company. I mean, you can learn a lot about how real estate finance works by working in those types of jobs. So yeah, I mean, just get out there. I mean, I've run into a lot. I mean, I've done all the hiring for the companies that I've worked for, including obviously the one I'm at now. And you talk to kids out of college, and they have aspirations, which it's important to have, but it's like, You just want to tell them, it's like, dude, here's a job. It may not be what you want. It may not pay what you want, but like you are going to get, a master's level or a PhD level degree in like learning what we do. And then that's important experience to gain.
Yeah, that's great advice. I was just interested. You said that it changes a lot as you progress through your career. I just wanted to know what that entails, maybe the advice you'd give to someone later in their career.
Yeah. So later in your career, hopefully as you become more successful, it's sort of interesting. You become less and less hireable the further you go on in your career because essentially you make too much money, right? And so to switch jobs, there's not as many jobs out there that pay, throwing out the numbers not important, but that, pay a ton of money versus jobs, that pay sort of starting salaries. And so, you know, once you get to a certain point in your career, switching jobs is actually not a good thing, right? And so, I would look at resumes from kids, I guess I'll call them, who, they had 3 jobs in 5 years. Not a big deal if they were in their mid 20s, early or late 20s. But there is a certain point at which, if I looked at a resume of someone who was closer to my age, let's say they were 40 and they could not hold a job or they refused to stay in a job for more than a couple of years, that becomes sort of a red flag. And so um, there's no magic number. I mean, I'm not going to sit here and tell you. I mean, I know what in my mind that sort of age is, where it's like you have to look at a resume and say, okay, this person stayed at this job for 5, 6, 7 years, even though maybe it wasn't the best job, or you know, uh, maybe they could have like found a different job and made a little bit more money. But like you got to stick it out. At some point in your career, you got to get to the point where you got to stick it out and stay at a job for I would say 5 years at a minimum. And of course, if it's just absolutely horrible, you're being mistreated or abused, you don't do that. But just generally speaking, as you get older and older, you can't just kind of flint around because it shows it people it doesn't show well. And then also, like I said, if you're the person actually moving jobs, like it's hard to find jobs that pay you, that much money because there's just fewer of them and there's still plenty of people who are looking for those jobs. So that's how the advice changes, in my opinion.
Totally. I mean, yeah, I think that's all the questions we have.
Yeah. So
Thank
thanks
you
for joining us.
so
It was a
much.
pleasure.
That's great.
We really appreciate it and all your insight. So yeah,
Yeah.
Thanks,
thank you.
guys. I appreciate it. And I'm impressed that you've started this channel and I wish you all the success.
Thank you so much.